Hey everyone, welcome back to Corporate Decoder. Today we're diving into some fund reports and trust me, even though it sounds boring, we'll uncover if this fund is actually investing wisely or just throwing money at shiny objects. It's like a financial treasure hunt, but instead of gold, we're looking for good decisions. We're checking out the Pinnacle Multi-Strategy Core Fund's semi-annual shareholder report. The fund aims for high returns with reasonable risk, but let's see if their actions match their words. Do they actually do it? Before we begin, if you're all about getting the real deal from corporate paperwork, hit that subscribe button, join our Discord community, the link is in the description below to chat with other folks. Alright, let's start with the basics. This report covers the period from October of last year to March. We're looking at Class A shares and you can find more info on their website, but we'll handle the core details here. If you want to dig deeper later, the website has a prospectus, financial information, their list of holding and even proxy voting information. First up, let's talk about costs. Imagine you put $10,000 into this fund. For Class A shares, it would cost you 65 times over the last 6 months. That works out to be around 1.35% of your investment every year. This is the cost paid as percentage. Basically, if they make 1.35% or less, you are paying more than you are earning. Now, let's look at the fund stats. They've got about $32.3 million in net assets. That's the total value of everything they own minus what they owe. The fund holds 22 different investments. The advisory fee, what they pay the investment advisor, came to almost $89,000. The portfolio turnover is 19.1%. This means the fund is actively buying and selling investments, which can create trading costs. Basically, that means they switched out almost 2 times the entire holdings of the portfolio, which could potentially impact taxes. So what did they invest in? Almost all of their money, about 98.3%, is in exchange-traded funds or ETFs. The remaining 1.7% is in money market funds, which are super safe and liquid. These are like holding cash. Here's where it gets interesting. Their top holding is the SPDR S&P 500 ETF Trust, making up almost 24.5% of their net assets. This ETF tracks the S&P 500, which is a list of 500 of the largest companies in the US. Second is the Pinnacle Focused Opportunities ETF, making up 24.2%. Other big positions include the Invesco QQQ Trust Series 1, tracking the top tech companies, and the SPDR Dow Jones Industrial Average ETF Trust. These top holdings give you a sense of where the fund is placing its bets. Now, let's shift our focus to Class C shares. This is the second type of share they offer in this fund. If you invested $10,000 in Class C shares, your costs over the last 6 months would be $101. That translates to an annual expense ratio of 2.10%. So they are making less than 210%. You would be losing money. The fund's net assets and portfolio holdings are the same as Class A, standing at $32.233 million and 22 holdings respectively. Because the underlying assets are the same, it makes sense. The asset allocation and top 10 holdings mirror those of Class A shares, with the SPDR S&P 500 ETF Trust and Pinnacle Focused Opportunities ETF leading the way. Finally, let's discuss Class I shares. This is the third share class in this fund, but don't worry, we will go fast because you get the gist by now. The cost for Class I is only $53 per $10,000 invested over 6 months. That's an expense ratio of 1.10% annually. Once again, the net assets remain consistent at $32.3 million. It makes sense because it's the same assets just divided into different share classes. Not surprisingly, the top holdings are the same as the other classes, SPDR S&P 500 ETF Trust and Pinnacle Focused Opportunities ETF. Now, let's jump into the financial highlights. We will only talk about Class A for the purpose of time. This helps us understand how the fund performed. At the beginning of the period, the net asset value, or NIV, was $13.27 per share. The fund earned 0.32 cent per share from its investments, but lost 1.111 per share due to changes in the market value of its investments. Basically, they earned very little, but lost a lot more than they earned. Not off to a great start. After accounting for fees and distributions, the M ended up at 11.81 ton per share. The total return, which assumes you reinvested all earnings back into the fund, was negative 6.44%. So that means that you lose money in this fund. The fund had around $6.4 million in net assets at the end of the period. The gross expense ratio, which doesn't count when they reduce fees, was 1.95%, but after fee waivers it was 1.35%. This is important to look at because the investment manager may choose to no longer waive fees. The portfolio turnover rate was 181%, confirming the active trading strategy that may impact taxes. Now, let's assess the situation. The fund strategy of investing in ETFs provides diversification, but it also means they are paying fees on top of fees. The relatively high portfolio turnover suggests they are trying to beat the market, but their recent performance isn't exactly stellar. The negative total return for the most recent period is a cause for concern. The fund's success hinges on whether those top ETF choices outperform their fees. If these fees are so low, why didn't they just simply invest in the S&P 500, which had very similar earning profile, but probably at a fraction of the cost? And the risk is in the high turnover, which can increase costs and reduce returns if not managed effectively. Alright, that's our breakdown of this fund's semi-annual report. What's your take on these numbers and what they signal for this fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, don't forget to check out our Discord in the description below. Thanks for watching. See you next time.